Okay, let's unpack this. Imagine a company bakes about 5% more pizza this year than they did last year.
Right, so a solid year. Business is good.
Exactly. But then they go out to their investors and somehow announce that the size of their growth, like the actual value they are delivering, is up 21%.
Yeah, on paper, that looks like a total contradiction.
It looks like a magic trick. So today, we're going to look under the hood of exactly that kind of magic trick. And in the process, we're going to diagnose the financial health of the everyday American consumer.
It's a really fascinating dynamic to dissect. I mean, especially right now. We are analyzing the Q2 2026 earnings call for Bread Financial.
Right, ticker BFH.
Exactly, from July 23, 2026. And for those of you tracking the broader economic weather, Bread Financial is this massive engine operating just out of sight.
They're kind of everywhere once you know what to look for, right?
Oh, absolutely. They power the co-branded retail credit cards, the point-of-sale loans, direct consumer banking. It's the brands you interact with every single day.
They are essentially the invisible financial plumbing connecting major retailers to your wallet.
That's a great way to put it, yeah.
So our mission for this deep dive is to really tear into this earnings report. We're going to take the Wall Street jargon, the basis points, the regulatory capital metrics, and translate them.
Make it make sense for the real world.
Exactly. We want to understand the actual mechanics of how consumer finance works right now in the summer of 2026. So let's start with that contradiction I mentioned.
The pizza analogy.
Right. Looking at the headline numbers, Bread Financial reported a net income of $146 million.
Which is the actual pile of profit left over after paying the bills.
Yeah, and that represents a 5% growth year over year. Total revenue hit $993 million, which is up 7%.
Pretty steady growth.
But then you look at their diluted earnings per share, their EPS, that number came in at 3.55 for the quarter.
Which is a massive 21% increase year over year.
Right. So the divergence between a 5% growth in net profit and a 21% growth in EPS is huge. What's going on there?
It is a textbook case of aggressive, deliberate capital allocation. When you see a gap that wide, you are watching a management team actively engineering their balance sheet.
To maximize the return for the individual shareholder, right?
Exactly. They are pulling levers to make each share more valuable.
I always think about this through that pizza analogy. The total net income is the pizza. They baked a 5% bigger pizza.
Right, the pie is slightly larger.
But the shareholders are the people sitting around the table waiting for a slice. If the company actively kicks some people out of the dining room, meaning they buy back those shares and just remove them from existence, they can cut the pie into fewer slices.
Fewer but much wider slices.
Exactly. So I, as a remaining shareholder, feel like I'm getting a 21% bigger meal, even though the kitchen only produced 5% more food. Isn't that just an illusion of massive growth?
I mean, it is financial engineering, but you have to remember that in corporate finance, that isn't inherently a pejorative term.
Okay, fair enough.
Bread Financial looked at their excess capital and executed a really massive share repurchase program. During the quarter, they bought back 2.8 million shares of their own common stock.
Wow. How much did that cost them?
They spent $241 million to do it. And by removing those 2.8 million shares, they reduced their weighted average diluted common shares outstanding by 14%.
So that mathematically forces the earnings per share up?
Right, because the denominator in that EPS equation just shrank significantly.
But wait, why spend $250 million on your own stock? I mean, why not take that $241 million and invest it in new technology or acquire another company?
We'll just hold it in reserve.
Yeah, exactly. Just sit on it like a fortress in case a recession hits.
It comes down to how management values their own enterprise versus the alternatives. CEO Ralph Andretta and CFO Perry Beberman are signaling extreme confidence here.
Confidence that they aren't about to hit a wall.
Exactly. You don't spend $241 million buying your own stock if your internal models are flashing warning signs about a massive spike in consumer defaults next quarter.
Because you'd need that cash to cover the losses.
Right. Furthermore, when a bank stock is trading at a level management believes is fundamentally undervalued, buying back stock becomes the highest yield investment they can make.
It's just a guaranteed accretion of value to the remaining shareholders.
Precisely. It makes financial sense if they believe the stock is cheap.
Okay, that makes sense if you have cash burning a hole in your pocket. But looking at the transcript, they were also raising money at the exact same time.
Ah, yes. The preferred stock issuance.
Yeah. They didn't just buy back common stock. They issued $135 million in preferred stock at an 8.875% dividend rate.
It does seem a bit contradictory at first glance.
It feels incredibly counterintuitive. Why are you spending cash to buy back stock on one hand, but issuing expensive preferred stock and agreeing to pay almost a 9% yield on the other hand?
To understand that maneuver, we really have to pull back the curtain on bank regulation, specifically a metric called the CET1 ratio.
Which stands for Common Equity Tier 1, right?
Exactly. So in the post-2008 financial world, regulators demand that financial institutions hold a very specific buffer of ultra-high quality capital.
Basically to absorb potential losses so we don't have another meltdown.
Right. You can't just lend out every dollar you have. You have to keep a fortress of equity. CET1 compares a bank's core capital against its risk-weighted assets.
And where did Bread Financial sit on that front?
For Bread Financial, their CET1 sat at a very healthy 12.9% this quarter.
Okay, so if the capital buffer is already healthy at 12.9%, what is the point of issuing preferred stock at almost 9%?
Because a bank's capital stack is tiered. Common stock is actually the most expensive form of capital.
Because it carries the most risk for the investor.
Exactly. They are the absolute last to get paid in a bankruptcy. Preferred stock sits a bit higher up in the capital structure.
So it's a bit safer for the investor, and they accept a fixed dividend.
Right. And for regulatory purposes, preferred stock still counts towards certain capital adequacy buffers.
Oh, I see. So by issuing that $135 million in preferred stock, Bread Financial satisfied those regulatory capital requirements.
Yes. That maneuver freed up their common equity. They essentially swapped a portion of their capital base from common equity to preferred equity.
So let me get this straight. They raise capital via preferred stock to keep the regulators happy and then use their operating cash to buy back the common stock.
Right. Which shrinks the share count and boosts the EPS.
That is wild.
CFO Beberman actually noted that their core earnings boosted their capital ratio by 340 basis points.
Okay, so organic capital generation.
Exactly. And that allowed them to turn around and spend 320 basis points on stock repurchases and dividends.
They are earning the capital through their operations, and they are systematically returning it to shareholders while keeping the regulatory scales perfectly balanced.
It's a very sophisticated optimization of their funding costs.
But the financial engineering only works if the underlying business is actually generating cash. I mean, you can't optimize a balance sheet if the underlying consumer is defaulting.
No, absolutely not. The core engine has to be running.
And this brings us to what I think is the most fascinating part of this earnings call. Where is the money actually coming from?
The macro environment right now is definitely interesting.
Right, because in the summer of 2026, the macro narrative is just dominated by inflation fatigue. We hear constantly about stretched consumer budgets.
Everyone is feeling the pinch.
Yet, Bread Financial's credit sales accelerated to $7.5 billion. That is an 11% increase year over year.
It's a staggering number.
And their end-of-period loans reached $18.5 billion, which is up 5%.
11% credit sales growth on a base of that size is a massive data point.
It really is.
When a single consumer finance company processes $7.5 billion in a quarter, you are getting a real-time, ground-level diagnostic of American economic psychology.
CEO Ralph Andretta pointed out exactly where that spending is heavily concentrated to.
He had some very specific verticals he called out.
Yeah, he highlighted travel and entertainment, sporting goods, and he specifically detailed their expansion in the furniture vertical.
Which is a very deliberate strategy for them.
They've launched new co-branded programs with Raymour and Flanigan, Ethan Allen, and Furniture First.
Big ticket items.
Plus, they noted serious momentum with their Bread Pay product, which is their installment loan system, specifically partnering with Vivint, the smart home technology company.
Right. Home security and tech.
Now, I have to push back on this narrative a bit. We know grocery prices are up. We know housing costs are up.
The inflation data is undeniable.
So when I see credit sales jumping 11%, my initial thought isn't, wow, the consumer is strong. My initial thought is people are drowning.
That they're borrowing just to stay afloat.
Exactly. Are people just putting groceries on plastic to survive? Are we just looking at a mirage of distress borrowing here?
It is the most common interpretation of rising credit balances in an inflationary environment, for sure.
It just seems like the most logical conclusion.
But the internal metrics from the specific portfolio actively contradict that distress narrative. We really have to look at the profile of the borrower here.
Okay, what does the profile look like?
Beberman explicitly pointed to their prime cardholder mix. Currently, 65% of Bread Financial's cardholders have a prime credit score.
Meaning a FICO score above 650.
Exactly.
Explain the behavioral difference we usually see between a prime borrower and a subprime borrower in an environment like this.
Well, a subprime borrower, typically below a 600 FICO, operates with very little financial margin.
They live paycheck to paycheck.
Right. So when inflation hits staples like food and gas, they exhaust their cash reserves immediately and turn to revolving credit for basic survival.
And what about the prime borrower?
A prime borrower, heavily concentrated in that 650 to 750 range, generally has stable employment. They feel the pinch of inflation, certainly, but it's an annoyance. It's not an existential crisis.
Because the labor market in mid-2026 remains relatively robust.
Right, with unemployment hovering below 5%. Because that prime consumer feels secure in their job, they don't stop spending. They change how they finance that spending.
So they aren't buying groceries on these cards.
Look at the verticals Andretta highlighted. Ethan Allen dining sets, Vivint smart home systems, travel and entertainment.
These are highly discretionary, high-ticket purchases.
Exactly. A consumer in financial distress does not walk into an Ethan Allen to finance a $4,000 sofa.
No, they definitely don't.
That is the behavior of a confident consumer. However, because cash flow might feel slightly constrained due to broader inflation, they choose to finance that sofa at the point of sale rather than liquidating their savings.
So they are using credit as a deliberate cash flow management tool.
Exactly.
It's strategic leverage. If I want the smart home system now, but I don't want to drain my checking account, I use Bread Pay to lock in predictable monthly installments.
It smooths out the expense.
That completely reframes the 11% growth. Bread Financial isn't catching the fallout of desperation. They are actively curating a portfolio of resilient, employed homeowners who are nesting.
And that is why securing partnerships in the furniture and home improvement verticals is such a vital strategic move.
Because it naturally filters for a better borrower.
Yes. Furniture naturally attracts a homeowner demographic. Homeowners have built-in equity, and historically they exhibit a much more stable financial profile and lower default rates compared to transient renters.
Makes total sense.
By pivoting their business development toward these specific brand partners, Bread Financial is essentially underwriting the stability of the American housing market.
Rather than the volatility of fast fashion or mall retail.
Exactly. It's a huge structural upgrade to their portfolio.
But if they are originating all these high-ticket loans, growing the loan book to $18.5 billion, that cash has to come from somewhere.
Right. You need capital to lend capital.
Bread Financial isn't the Federal Reserve. They can't just print the money to pay Ethan Allen when I walk out with the sofa. So how are they funding this massive acceleration in credit sales?
That is the structural shift that management spent a significant amount of time highlighting on the call. Bread Financial has fundamentally transformed the liability side of their balance sheet.
Okay, what was the big headline metric there?
The headline metric here is their direct-to-consumer deposits, or DTC deposits. They grew by $1.3 billion in the quarter.
Reaching a total of $9.4 billion.
That is a 16% year-over-year increase, and it represents the second strongest quarter of growth since they launched the program back in 2019.
And the really critical piece of data, which I flagged when I was reading the transcript, DTC deposits now make up exactly 50% of Bread Financial's total funding mix.
Reaching that 50% threshold is a monumental de-risking event for a bank of this specific profile.
It really is. You know, I try to visualize bank funding like a city's water supply.
Okay, let's hear it.
If a city is growing rapidly, meaning the bank is originating a ton of new loans, it needs water. Historically, a lot of specialized lenders had to buy that water from outside.
Through the institutional markets.
Exactly, the wholesale debt markets. They basically paid a fleet of trucks to bring the water in. It works, but if there is a regional drought or if the truck drivers suddenly demand triple the pay, the city is in massive trouble.
It's a great analogy. The institutional debt markets are what we call hot money. Wholesale funding, securitizations, institutional borrowing, it's all highly sensitive to macroeconomic shocks.
So it can dry up quickly.
Exactly. If the bond market panics or if the Federal Reserve spikes interest rates aggressively, the cost of that institutional funding skyrockets almost overnight.
And if your cost of funding spikes, but the interest rate you charge your consumers is fixed or capped,
Your profit margin completely collapses.
so by pushing DTC deposits to 50% of their funding, it's like the city finally finished boosting its own massive independent water reservoir.
They've secured their own supply.
Half of the water they need now comes from retail customers, just everyday people opening high-yield savings accounts or certificates of deposit directly with Bread Financial.
They aren't relying on the trucks anymore. They own the reservoir.
Right. And that shift completely alters their risk profile, doesn't it?
Completely. Retail deposits are fundamentally sticky. Everyday consumers do not pull their CDs or savings accounts out at the first sign of Wall Street volatility.
Mainly because those deposits are FDIC insured up to $250,000.
Exactly. It provides Bread Financial with a stable, predictable, and historically cheaper cost of funds.
We can actually see the mathematical result of this strategy in the transcript. Their net interest margin, or IMIN, actually increased to 18.5%.
Let's break down NIM for a second because it is the ultimate scoreboard for a lender.
Okay, let's do it.
Net interest margin is the difference between the interest income a bank generates from its loans and the interest expense it pays out to its depositors and institutional lenders.
So it's the spread.
Exactly. And an 18.5% NIM is exceptionally robust. In a higher for longer interest rate environment, which management firmly believes we are in right now, the institutions that control their own direct retail deposits are the ones that maintain their margins.
Because they aren't paying a premium to borrow from Wall Street.
Right. CFO Beberman noted that a year ago, DTC deposits represented only 45% of their funding. Now it's 50%.
So they are trending in the right direction.
Yes. This trajectory insulates them from the whims of the bond market and gives them the financial firepower to confidently underwrite that 11% growth in credit sales.
Okay, so the reservoir is half full of cheap, stable retail deposits. They take that money and they lend it out to prime consumers buying furniture and booking vacations.
That's the business model.
But the $18.5 billion question is, are those consumers actually paying the money back?
Which brings us to the credit quality metrics and the highly counterintuitive world of modern bank accounting.
Yeah, this part of the call was wild because looking at the raw data in the report against all the macroeconomic anxiety out there, Bread Financial's credit metrics are actually improving significantly.
They really are.
The net loss rate dropped to 6.98%. That is an improvement of 90 basis points year over year. And sequentially, from the last quarter, it's down 35 basis points.
And we should define what that means in dollar terms.
Please do.
A basis point is 1/100%. So a 90 basis point improvement means they reduce their losses by nearly a full percentage point across an $18.5 billion portfolio.
Wow. That is a massive retention of capital.
Huge. And the delinquency rate, which is usually the early warning radar for future defaults, is down to 5.25%.
Which Beberman pointed out is actually below their 5-year historical average.
Right. And their credit reserve rate, the vault of emergency cash they keep on hand to cover bad loans, is fortified at 11.23%.
It seems like they are in a really strong position.
Beberman even projected a path to driving that net loss rate all the way down to 6.0% over the next 2 years.
Assuming unemployment stays below 5%, right?
Yes, contingent on that macro factor.
Yeah.
But it still signals immense confidence in their proprietary underwriting models. They are actively tightening the perimeter, focusing on higher quality borrowers, and the data proves it's working.
But this is where the transcript gets incredibly confusing to me. If the credit metrics are improving that drastically, if fewer people are defaulting and delinquencies are dropping below historical averages, then the company shouldn't need to hold as much emergency cash in that reserve vault, right?
Logically, yes, you'd think so.
Last year, when metrics were arguably worse, they released a massive $74 million from their reserves, and that cash flows right back to the bottom line as profit.
Exactly.
But this year, with highly improved credit, they only released $3 million. I just don't get it. If credit is getting so much better, why aren't they freeing up a ton of cash?
It feels like a paradox. To unravel it, we have to look at one of the most significant accounting changes in modern financial history.
You're talking about CECL.
Yes, CECL, which stands for Current Expected Credit Losses.
I know this has been a thorn in the side of bank CFOs for a few years now. How does CECL actually work in practice?
Historically, banks operated under an incurred loss model. which was governed by older accounting standards.
Okay, how did that work?
Under that old model, a bank only set aside reserve capital when it became probable that a specific loan was going bad. You waited until a borrower actually missed a payment or showed obvious signs of distress before you locked away the emergency cash.
And the problem with that was?
The 2008 financial crisis exposed the fatal flaw in that model. By the time the bank started reserving capital for bad mortgages, it was way too late. The losses had already cascaded through the system.
They waited to see the smoke before they went out and bought fire extinguishers.
That's a perfect way to put it. So the regulatory bodies introduced CECL, which shifted the industry to an expected loss model.
Okay, meaning they have to predict the future.
Exactly.
Yeah.
Under CECL, the very secondest Bread Financial issues a new loan. The moment you swipe your card for that smart home system, Bread Financial must use macroeconomic models to estimate the expected losses over the entire lifetime of that loan.
Wow.
And they must immediately lock away the cash reserves for it on day one.
So even if I have a flawless 800 FICO score and I've never missed a payment in my life, Bread Financial has to assume a statistical probability that I might get fired or get sick 3 years from now and default.
Yes.
And they have to reserve for that risk today.
Precisely. It is effectively a growth tax. And this solves the paradox of the $3 million reserve release.
How so?
It's the mathematical collision of two different forces on the balance sheet. Force number one. The older, seasoned loans in Bread Financial's portfolio are performing beautifully.
Because defaults are down 90 basis points.
Right. Bread Financial's models tell them they have too much money locked in the vault for those old loans. Normally, they would take tens of millions of dollars out of the vault and recognize it as a profit.
Okay, that makes sense. That is the downward pressure on the reserve.
But force number two is the 11% growth in new credit sales.
Because end-of-period loans grew by 5% overall, they are booking a massive wave of brand new loans.
Exactly. And under CECL, every single one of those new loans demands a day one reserve.
I see.
Bread Financial is being forced to shovel new money into the reserve vault to cover the massive new loan growth, which almost perfectly offsets the money they are allowed to take out of the vault because the old loans are performing well.
So the fact that they only released $3 million isn't a secret warning sign that their loans are quietly rotting.
Not at all.
It's actually proof that their growth engine is running so hot that the day one growth tax is just eating up all the savings from the improved credit quality.
CFO Beberman addressed this explicitly on the call. He stated the variance in the reserve build was primarily driven by the strong sequential period-end loan growth in the second quarter.
That makes total sense now.
For a consumer finance company, a massive reserve release often indicates that your portfolio is shrinking. It means you have no new loans demanding capital.
So shrinking is bad, growing is good, even if it hides the reserve release.
Right. By only releasing $3 million, Bread Financial is proving they are successfully originating high-quality assets.
Yeah.
They are happily paying that day one growth tax because those new loans will generate substantial net interest margin over the next several years.
That is a brilliant breakdown. Reading a raw headline number without understanding the underlying accounting mechanics can give you the exact opposite of the truth.
It happens all the time in financial media.
But let's look at the expense side of the ledger, because managing risk isn't the only cost of doing business.
True.
If these new loans are performing better and generating more profit over time, you would assume Bread Financial gets to keep all that expanded margin.
But in the co-branded credit card space, you don't eat alone.
No, you definitely don't. The brand partners demand their share. This is the structural reality of retailer share arrangements, or RSAs.
Exactly.
Looking at their non-interest expenses, they ticked up 3% year over year, hitting $483 million.
And the CFO called out a few specific drivers for that.
Yeah, he mentions slightly higher employee wages and medical claims, which makes total sense in this inflationary environment.
Sure.
But the primary driver pushing expenses up was higher retailer share arrangements. What exactly goes into an RSA contract?
The RSA is the foundational economic agreement of the co-brand model. When Bread Financial partners with a massive retailer, let's stick with the Ethan Allen example.
Yeah.
Bread doesn't simply pay a flat marketing fee to use the Ethan Allen logo.
It's much deeper than that.
Yeah, they enter into a complex profit-sharing or revenue-sharing matrix. The retailer brings their highly loyal, high-intent customer base, and Bread Financial brings the banking charter, the underwriting algorithms, and the capital.
And the contract stipulates that Bread Financial will kick back a significant percentage of the program's overall profitability to the retailer.
Exactly.
I always frame this dynamic like a major Hollywood blockbuster.
Okay, I like movie analogies.
Suppose Bread Financial is the movie studio. They want to make a massive summer tentpole film, so they go out and hire the biggest A-list movie star on the planet.
And the star is the brand partner.
Right. The star guarantees an audience. But the star's agent demands a massive cut of the back-end box office profits.
So if the movie bombs, the star doesn't get much.
Exactly. But if the movie clears $1 billion globally, suddenly the studio has to write a $50 million check to the actor.
Right.
It's a massive expense line item on the studio's accounting sheet, but the studio is thrilled to write that check because they only have to write it if the movie was an absolute smash hit.
That alignment of incentives is crucial. Beberman explicitly instructed the analysts to view rising RSA expenses through that exact lens. He stated, "To be clear, these higher payments are a positive indicator."
Break down the math of why the RSA payment went up this quarter specifically.
The profit pool of a co-brand portfolio expands through 3 primary levers, all of which moved in Bread Financial's favor this quarter.
Okay, what's lever number 1?
First, credit sales were up 11%. That means higher interchange fee revenue every time the card is swiped.
Makes sense. Lever 2.
Second, loan yields improved, likely due to pricing actions and the higher interest rate environment we discussed.
And the third?
Third, and most importantly, net losses dropped by 90 basis points.
Because every dollar you don't lose to a defaulting borrower falls straight to the bottom line of the program's profit calculation.
Precisely. Because Bread Financial managed the underwriting risk so effectively, the total net profit of the Ethan Allen or Raymour and Flanigan portfolios expanded significantly.
And the retailer's percentage of that larger pie translates to a larger nominal dollar payout.
Yes. Beberman noted he expects these RSA payments to increase again in Q3, driven by continued loan growth and improved profitability.
It creates a virtuous operational cycle, doesn't it?
It really does. The better Bread Financial manages the risk, the larger the check they hand to the retailer. The larger the check the retailer receives, the more heavily the retailer trains their sales associates to push the Bread Financial card at the point of sale.
Which drives more prime consumers into the ecosystem. It's brilliant.
It is the cost of a hit program.
Yeah.
But you did mention earlier that non-interest expenses were also being pushed up by wages and medical claims for their human employees.
Right. A 3% rise isn't disastrous, but in a business built on thin margins and massive volume, you really cannot let human headcount costs scale linearly with your loan growth.
No, you can't.
If your loan book grows 5% and your payroll grows 5%, you have zero operational leverage.
Exactly. And Bread Financial Management outlined a very specific strategy to decouple their growth from their human expenses.
And it involves the most hyped technology of the decade.
We have finally arrived at the integration of artificial intelligence.
We couldn't do a 2026 deep dive without talking about AI.
True. But CEO Ralph Andretta was very deliberate in his phrasing during the opening remarks. He didn't just casually drop the acronym AI to satisfy a bingo card for Wall Street analysts.
He had a very specific use case.
He stated they're strategically integrating AI to advance operational excellence, specifically targeting what he called agentic commerce and servicing.
So let's strip away the corporate speak. What is the fundamental difference between agentic AI and the chat box we've been arguing with on websites for the last 5 years?
The leap from a standard large language model to agentic AI is profound. A standard chatbot is reactive and informational.
Right. You type, "What is my current balance?"
And the system identifies the keyword balance, queries a database, and displays a number. It is just a glorified search interface.
So what makes an AI agentic?
Agentic refers to autonomous AI agents that have been granted tools, memory, and operational authority. They do not just answer questions, they are authorized to take multi-step, complex actions across a company's back-end systems on behalf of the customer.
Entirely without human intervention.
Entirely without a human.
Give me a tangible example of how an AI agent handles a friction point compared to a traditional human call center rep.
Okay, let's say a customer misses a payment because their bank account routing number changed due to a bank merger.
Happens all the time.
Under a legacy system, the payment fails. A few days later, an automated system generates a late fee and mails a physical or electronic notice. The customer receives it, gets frustrated, and calls the 1-800 number.
And then they navigate a clunky voice menu, wait on hold for 15 minutes.
And finally, connect with a human agent. The human has to authenticate the caller, listen to the explanation, manually navigate to the fee waiver screen, review the customer's history to see if they qualify for a courtesy waiver.
Then process the waiver, navigate to a different screen, securely capture the new routing number, and reprocess the payment.
Exactly. That single interaction might take 12 minutes of handle time. And in a call center, handle time is incredibly expensive.
So how does the agentic AI handle that exact same scenario?
The moment the payment fails, the AI agent detects the specific error code from the automated clearinghouse. It immediately synthesizes the context and proactively texts the customer. We noticed your payment failed due to a routing error. Did your bank information recently change? Reply yes to securely update it.
Wow. So the customer replies, yes.
The agent instantly generates and sends a secure, one-time authenticated link. The customer inputs the new routing number. The AI agent automatically receives the data, updates the mainframe, and reinitiates the payment.
And what about the late fee?
Simultaneously, the agent queries the customer's 5-year payment history, recognizes a flawless record, autonomously applies the logic of the bank's fee waiver policy, weighs the $35 late fee to preserve goodwill, and sends a final text.
Something like, your new account is linked, payment is processing, and we've waived the late fee for the inconvenience.
Exactly.
And the total time elapsed is maybe 60 seconds, costing Bread financial fractions of a penny in compute power instead of $12 in human labor.
Yes. And more importantly, the customer experience is frictionless and proactive rather than reactive and adversarial.
Now, I understand the theoretical power of this, but in a heavily regulated industry like consumer finance, deploying autonomous AI carries massive risk.
It's not without its dangers, for sure.
We are talking about fair lending laws, UDAP compliance, unfair, deceptive, or abusive acts or practices. If an AI agent hallucinates or applies a fee waiver policy inconsistently based on demographic data it somehow infers, the regulatory fines would be catastrophic.
Absolutely.
So is Bread Financial actually deploying this at scale, or is it just a pilot program?
Well, CFO Beberman tied this technology directly to their financial guidance, which means it is absolutely moving the needle right now.
Right.
He explicitly stated that these AI and operational excellence initiatives generate tens of millions of dollars in tangible savings.
Wow. So it's real.
Very real. The regulatory guardrails are undoubtedly intense. These agents operate within highly constrained logic trees rather than open-ended generative text environments. But the financial impact is undeniable.
And Beberman noted they aren't just pocketing those tens of millions of dollars to boost the quarterly profit.
No, they are redirecting those savings to self-fund their growth investments. This is the definition of positive operating leverage.
Explain that concept really quickly.
Because human wages and medical claims are inflating, the baseline cost of running the business is rising. By deploying agentic AI to absorb the massive volume of routine servicing tasks, especially as the total loan portfolio expands by 5% and transaction volume jumps 11%, they can maintain a relatively flat human headcount.
So they are processing significantly more volume and generating more revenue without a corresponding linear spike in human capital expenses.
Exactly. It completely protects their margins heading into the back half of the year.
Which brings us to the final piece of the puzzle, the windshield.
Looking for it.
Right. We have spent an hour dissecting the rearview mirror. It was a demonstrably strong quarter. The loan book is growing, credit quality is tightening. They successfully shifted their funding model to rely heavily on retail deposits, and they are leveraging autonomous AI to bend the cost curve.
This is a very solid foundation.
But the stock market is a forward-looking mechanism. What is Bread Financial's management seeing on the horizon for the rest of 2026?
Structurally, their outlook is highly optimistic. Management officially raised their full-year 2026 guidance during the call.
That's a huge signal.
It is. They initially projected average loan growth and revenue to be up in the low single digits. They have now revised that upward to low to mid single digits.
And what about credit losses?
Crucially, they also improved their net loss rate outlook, tightening the projected range down to 7.0% to 7.1% for the full year.
Raising guidance halfway through the year is a bold move. It leaves you zero room for excuses in Q3 or Q4.
It puts a lot of pressure on the back half of the year.
But reading through the analyst Q&A portion of the transcript, it wasn't a completely unbridled victory lap. There are macroeconomic storm clouds that management is tracking very closely.
They are managing a credit portfolio, which means they are paid to be professional pessimists.
Fair point.
When the analysts pressed Beberman on the exact cadence of consumer spending throughout the quarter, he provided some very granular, slightly cautious data. He noted that while June was exceptionally strong for credit sales across the entire industry, July showed early signs of a pullback.
The momentum decelerated.
Yes.
And he specifically warned about the price of a gallon of gas, right?
She did, and it is a vital transmission mechanism for consumer distress. He told the analysts, if fuel prices go back up, consumers are going to take some of their available cash to put it towards dealing with things at the fuel pump and maybe pay a little less on their credit card bills.
That dynamic is fascinating. Gasoline is highly inelastic. You have to drive to work. You have to drive your kids to school. You cannot easily substitute or reduce your consumption in the short term.
No, you really can't.
If the price of gas spikes by $1 a gallon, a commuter with a truck or an SUV might suddenly find themselves spending an extra $100 or $150 a month just to maintain their baseline existence.
And that $150 has to come from somewhere within a fixed monthly budget. For the prime consumer, it doesn't mean they default on their mortgage.
Right.
But it does mean that the available cash they were previously using to pay down their passion, Bread financial credit card balance in full every month, is suddenly redirected to the Exxon station.
So they drop from paying the full statement balance to paying the minimum due.
Exactly. And if they carry a balance longer, their utilization goes up, and eventually a small percentage of those consumers tip into delinquency.
It's a domino effect.
This is why management is applying what they call prudent weightings to downside scenarios in their macroeconomic models. They explicitly cited the ongoing uncertainty related to global conflicts and the potential downstream impacts on inflation and supply chains.
Now, I noticed another data point that initially looked like a warning sign to me. In the first quarter and second quarter, they were aggressively buying back stock, spending $241 million.
Right, we discussed that.
But they noted that in July, their stock buyback slowed down to just $25 million.
It's a sharp drop-off.
If you pair that slowdown in buybacks with the CEO's warning about fuel prices and a July spending pullback, it paints a picture of a management team that might be hoarding cash because they see a cliff approaching in the fall. Are they pulling the emergency brake?
It's an excellent synthesis of the data, but it actually misinterprets the operational calendar of retail finance. The slowdown in share repurchases in July is not a defensive retreat driven by fear.
Oh, really? What is it then?
It is a mechanical requirement driven by seasonal growth.
Walk me through the seasonality.
As we transition from the summer into the third and fourth quarters, we enter the back-to-school and ultimately the holiday shopping seasons.
Right, the busiest time of the year for retail.
Retail credit sales historically accelerate rapidly during these periods. As we discussed earlier with the CECL accounting standard, booking a massive wave of new holiday loans requires Bread Financial to hold more regulatory capital in their reserve vault immediately.
Oh, the day one growth tax.
Exactly. They need raw, unencumbered cash on the balance sheet to legally fund those holiday loans. If they aggressively spend all their excess capital buying back stock in July and August, they would artificially choke off their ability to grow the loan book in November and December.
So they are shifting capital from the corporate finance department directly to the front lines to fund the consumer. It's a reallocation of resources to capture the seasonal demand.
Exactly. They're keeping the powder dry for the core business. While they are keenly aware of the macroeconomic risks, fuel prices, global instability, their base case, assumes the labor market remains stable.
And they are positioning the balance sheet to capture the growth that comes with a stable, employed consumer base.
Right. Which
brings us to the ultimate synthesis of this deep dive. We started with a headline contradiction, a 5% net income growth, massing a 21% EPS explosion, and we unpacked the deliberate financial engineering and capital optimization behind it.
We discovered a consumer base that, while dealing with inflation, is largely prime, employed, and utilizing credit as a strategic cash flow tool for discretionary nesting purchases like furniture and smart homes, rather than desperate survival spending.
We looked at a fundamental structural shift in how a modern consumer finance company funds itself. They transitioned away from the volatility of institutional wholesale debt by building a massive, stable reservoir of direct-to-consumer retail deposits,
which now accounts for half of their entire funding base.
We navigated the counterintuitive accounting of CECL, proving that a minuscule reserve release is actually the mathematical byproduct of robust, healthy loan origination and an improving baseline of credit quality.
We examined the co-brand profit-sharing model, where rising RSA expenses are actually billboard advertising the profitability and health of the underlying portfolio.
And finally, we explored how autonomous AI agents are actively bending the expense curve, funding future growth by stripping out the human friction of routine servicing.
It really is like a comprehensive masterclass in managing a complex financial apparatus through a period of intense macroeconomic uncertainty.
So if you are listening to this, why does this matter to your everyday life? If you hold a retail credit card, if you are managing a corporate balance sheet, or if you simply want to understand the true pulse of the American economy beyond the political headlines, Bread Financial's data provides a vital empirical anchor.
It cuts through the noise.
It demonstrates that in the summer of 2026, the American consumer is bending, they are adapting their behaviors, but they are absolutely not breaking. As long as unemployment remains below that critical 5% threshold, the engine of consumer spending will continue to turn.
Though, as CFO Beberman reminded us, we must always keep one eye firmly on the price of a gallon of gas.
Before we sign off, I want to leave you with a final provocative thought to chew on, building on our discussion of agentic AI.
I'm intrigued.
We talked about Bread Financial deploying an autonomous AI to proactively text a customer, negotiate a fee waiver, and update a routing number.
A massive leap in efficiency for the bank.
But technology never develops in a vacuum. It develops symmetrically. If the banks are deploying autonomous agents to handle servicing and collections, it is only a matter of time before the consumer side adopts the exact same capability.
We're talking about personal AI financial agents.
Exactly. Imagine a near future where your smartphone's AI has complete read and write access to your financial life. Your personal AI agent notices that your checking account will be slightly overdrawn based on upcoming utility bills.
So it takes action.
Right. Without you ever lifting a finger, your personal AI autonomously contacts Bread Financial's AI.
The algorithms begin to talk to each other.
Your AI requests a temporary credit limit increase and proposes a customized 60-day installment plan for a recent purchase to free up cash flow.
And Bread Financial's AI instantaneously runs a risk model.
Exactly. It analyzes your history, counters the offer with a slightly higher APR, your AI accepts the terms, and the contract is cryptographically signed. This entire complex financial negotiation, restructuring your debt and adjusting the bank's risk profile, happens in milliseconds in the background while you are asleep.
The friction of human emotion, of shame, of waiting on hold is completely removed from the credit cycle.
When the algorithms are autonomously negotiating leverage and credit limits with other algorithms, where does the human being actually fit in the future of consumer finance? It's something to ponder the next time you swipe a piece of plastic. Thank you so much for joining us on this deep dive. We took the incredibly dense, murky waters of a corporate earnings call, and hopefully we found some clarity together. Until next time, keep looking under the hood.